Okay, now let's take a closer look at Uber's IPO. I am joined by Arun Sundararajan from New York City. He's a professor at New York University's Stern School of Business and also the author of The Sharing Economy. Arun, thank you very much for joining us. I appreciate it.
Delighted to be on.
We know that Uber stumbled out of the gate. The term being tossed around is stumble. And as John Terrett pointed out, it's off about 7% from its asking price. What happened?
Well, I think the problem started 3 or 4 years ago when Uber inflated its private market valuation to a level that was perhaps far higher than it should have been. They ended up with a pre-IPO price in 2015 and 2016 that was, at its peak, 68 billion. And so that set an unreasonable bar for a company that was so young. I mean, think about it. If any other company had been started 8 or 9 years ago and had gone public with a valuation of $70 billion, it would have been called a smashing success. The failure here that is being perceived is a failure of what happened 3 years ago, not a failure of the company.
Well, what does this say, and we heard John touch upon it, about investor appetite for these money-losing startup services?
Well, to me, actually, I believe that the worst mistake that Uber could make in the next few years is to be pressured by Wall Street and to succumb to investor pressure and start trying to sort of make a profit sooner than it needs to. They are currently, both Uber and Lyft put together, constitute about 1% of US spending on personal transportation. A vast majority of that money goes into buying and maintaining cars. Uber is going to be a $1 trillion company if they can increase that 1% to a low double-digit percent and do so sort of in other countries as well. But doing this is going to require patience. It's going to require investment in behavior change. It's going to require convincing suburban customers to sell their second car and use an Uber instead. It's going to require convincing a lot of people that car ownership is not necessary to get transportation when they need it. I often think of Amazon as a good parallel. 3-4 years into their life, Amazon had figured out how to sell books, movies, DVDs, consumer electronics. They could have said, well, now it's time to cash in and be profitable. That would have led them to being a successful sort of multi-billion-dollar company. But they didn't do that. They doubled down. They kept investing for over a decade, losing money to convince us to spend more and more of our retail budget through Amazon, and here they are, a $1 trillion company today. So Uber's got to do that with personal transportation.
Amazon arguably has a lot more tools at its disposal, and one thing that really stands out at me is that these IPOs are usually so carefully choreographed. Who's behind this, I guess, miscalculation? Is that fair? Is it the banks? Is it Uber? Is it the company's CEO who was brought in to really steer this company through the IPO?
See, I think it has to do with that $68 billion number, which was Uber's valuation sort of as far back as 2016. And that sort of set an unreasonable floor on what the IPO price could be. So, had Uber been valued at 20 or 30 billion a few years ago, then I think they'd have gone out the gate at a lower valuation. But I think that set, the insistence that they should not sort of go down from that number or they should go significantly up, perhaps set the floor too high. And so it was probably a combination of investors insisting that, the IPO price be higher than that number, the CEO not being able to sort of say, well, this is the right number, and the banks, sort of just playing along.
Aaron, also read a couple of articles that I thought were quite fascinating, and it may seem somewhat of a left turn at this point, but to any degree, does the fact the markets were dragged down by the ongoing concern about a trade war between the United States and China, does that hangover have any effect on Uber?
I'm sure that the timing of Uber's IPO could have been better for them. We're coming off a week where tech stocks went down, where the market in general went down, where market uncertainty is higher than it was, say, a month or two ago. So things might have looked a little different had they gone public, say, in late March or early April. But I think this doesn't take away from the fundamental point that they got too valuable too fast pre-IPO. And so that's what ended up leading to the, hey, we're going to take the company public at 120 billion, rather than what would have been a more reasonable level.
Real quickly, just 15 or 20 seconds, where do you see this company going down the road? You want them to pump the brakes on trying to make money, but you sound very positive about it.
Yeah, I think they should focus on demonstrating that they have positive contribution margins, that they can be profitable if they want, but they're investing it back into the business. And I think that they should demonstrate measurable market expansion, more and more types of consumers who are not using other forms of transportation and are switching to Uber.
Okay.
If they have those two metrics every quarter, I think that they can keep investors at bay.
Arun Sundararajan, thank you very much for your insight. We really appreciate it.
Okay, thank you. Always a pleasure.